And so actually, in the meantime, I will at least read our disclaimer,
Yes.
get that part out of the way. The opinions expressed in this presentation are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. This information is given in summary form and does not purport to be complete. While due care has been used in the preparation of this presentation and the information contained herein has been obtained from sources believed to be reliable, its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of Willow's control or MONECO's control. Past performance is not a reliable indication of future performance.
Yes.
So I just want to make sure if anyone can just shoot in the chat if you can hear us okay. Just wanted to make sure
Just like a thumbs up or anything that you have would be great. Okay, cool.
All right.
We got it.
Perfect. Excellent.
Okay, thank you.
Thank you so much for that.
All right.
Good. Want to make sure. It's been a while since we've been able to present in this room.
Yeah, it's so cool. We're together today, so it's nice.
So
Okay.
we'll dive right in. We've got several sections to go through that look at the health of the economy, the health of consumer, manufacturing, businesses, and then some charts. And we'll just sort of share our thoughts on what we see happening out there in the world. We had a few questions come in that we'll answer at the end. But if at any point you have questions or anything comes up or you want us to stop, do the little hand raise thing, or feel free to throw it in the chat, and we'll see if we can address it in real time or something.
Okay, cool. Let's roll.
All right, jumping in.
So
interest rates.
Nice. He has it nice and organized. I like it.
All right. So this is the yield curve as of yesterday.
Yes.
So blue is today, right? And red is from 1 year ago. So you can see this inverted yield curve has uninverted. Generally, that's a good sign, but when we go through these, it's still in what would you consider a transitionary phase? So
it still has some inversion there.
Right.
Yeah.
The really short end is still higher than like the 6 month end is still higher than the year to say 5 year. And so there's still an inversion there, but the long end has come up. It's really a wonky kind of.
Yeah, I just want to speak to this a little bit because, this inversion, the reason we follow the curve is because it is always a good predictor of directionally where the economy is going. And so normally you see an inverted yield curve and we're in a recession. We argue that we already were and already are in more of a stagflationary environment, and meaning higher prices and slower growth. Unless, of course, you're in the right industries, and then there isn't slower growth like technology. But as you look at this overall, I would say this is it's a bit the right way I would say is schizophrenic. In other words, it really doesn't know directionally where it's going. And I think that's really apropos for where we are right now with all the changes that are being made. I think in any situation, there's going to be this ambiguity, not knowing. I'm just going to throw this out there with a lot of layoffs taking place. I do think that puts us at more risk, along with higher prices. It puts us at more risk for a slower environment with higher prices. But that's, by the way, that's been going on a long time. This isn't anything new. It's just it just seems to be accelerating.
Right, just looking at historical inversions. So Fred, I don't know if you know this, but they've since updated how they show their data. So this is a little different than what I was used to seeing with how they present it. But it's got a new facelift, I guess, with the new administration. But typically, this is just to historically show when you have these uninversions happen in the yield curve.
Which is right here, and it's where it's a positive in this area.
It tends to precede a recession, and the big gray bars, vertical bars, those are all recessions, and you can see right before each one,
inversion,
there was this down
recession,
right?
Inversion, recession. Inversion, recession,
For the
inversion,
past 40
recession.
Plus years, this has been, well, the last 50 plus years, this has been the case.
Very typical.
And then you look at today, right, where we're in this inverted territory, and then now it's uninverted, so what comes next?
Yeah, and but you can see, right, we inverted, and then even though we're on the upslope, it comes in. Inversion, even though it's on the upslope, it comes in.
Mhm.
So we don't think we're out of the, I don't
Right,
think we're out of the
right.
woods, and I think, in this year in particular, I just think we're gonna have a bit of a choppy year.
Yeah.
Yeah, and again, this has all been in the works for a long time. It's just
Not new.
becoming obvious, I think. Yeah.
We've been talking about this one for, well, really since it dipped the first inversion in what, 3-4 years ago. So,
Mhm.
all right. So moving on to some risk indicators, things like bond spreads. Generally, they look
Okay.
okay. CDS spreads. I thought this was interesting. Apolitical here, but what credit default swap spreads for the USA, which is what this is looking at, our sovereign debt. When you see this line goes up, it says that the risk of default is increasing.
Mhm.
What I found interesting is sort of with the new administration coming in, the rate has actually come down. So what that would say, this is about November 4th. So
Okay.
post election rates, or the credit default swap rate has come in some, saying that markets are actually saying, hey, the chance of default in the US is actually a little less than it was, months before that.
So just to speak to this a little bit more, just so you know, what it's showing is that the spike there is showing that there's risk in the treasury having problems. And what Paul is speaking to has been in this slow, steady decline. And hopefully that will, remedy itself to the downside, because we don't want risk to be in our treasury.
We want to see our CDS rates for the US
Yeah,
in this range, the
preferably.
20s. That's
Mhm.
much better than the 40s.
Do we have another chart in here that shows the countries or
Yeah.
no? Okay.
So here's a sampling of other countries. In the USA, China is the light blue line there. Germany's green. Brazil's that really dark line. You see there's a recent uptick, but Brazil has actually come back in too. It looks at Mexico, which has been slowly rising, but it's still relatively low. And the average overall doesn't look too concerning.
Yeah. Okay.
Volatility, we'll skip that one.
Okay.
All right. Economic activity. So looking at,
So again, I just want to go back. We look at risk measurements, and we look at economics, and then we look at technology. And right now we're getting into the economics. Okay. So how does it look technically? How does it look from a risk perspective? So from a risk perspective, what this is all saying is there's not a lot of risk right now. Right now. Okay.
right at this moment in
At this
time.
moment.
Yeah.
Okay. All right.
So
let's
this is
see.
the leading economics index. It looks at 10 or so leading indicators, from the stock market to new orders to manufacturing to consumer demand for debt, these kind of things. When this dips below that red line, it's historically always been a recession. Now we've been there for months. It came back out and then dipped below again, but there has been no official recession call here, and it's slightly rising. One of the things that we've been really paying attention to is the components. The main driver for this has really been the stock market.
Yeah, so let's explain that to you. So this is the leading economic indicator, gives us an indication of how things are going in our economy. And we like this particular indicator because it does give us a forward look when we couple it with everything else we're doing. So let's just take a look what Paul's talking about here. So this was December of.
And we should get, just so everyone knows, this is last month. The new one hasn't come out yet, but it should come out in the next week or so.
Well, let's do the longer term look,
Yeah.
okay?
So those are
So
6 months back, right?
Leading credit index. So this is the financial component. These are all the components in there, and it's showing this is to the positive 0.45. The S&P 500 0.7744. And then interest rates, this is a negative draw on the economy. This next one, this is a negative draw on the economy. This is business conditions. This is new orders. This is a negative call on the economy.
Looking at manufacturing there.
Now, manufacturing, I know, awful. This is the non-financial component of the market. This is slightly positive. So really, like Paul said, the thing that's leading the market, leading the economy is the market. That's funny.
In
That
debt.
was a slip. A debt in the market.
Yep.
It's not like conditions of the economy. It's not like manufacturing and employment and building and all these things. So this is as of the end of December. So we really want to impress us that all hasn't been well. All hasn't been well for a while, okay? So.
Yeah, to feel really confident about the economy and the direction things are going, we'd really want to see a bunch
Oh,
of these
yeah.
things on the right
Yeah.
side here moving positive. We want to see average weekly hours increasing, manufacturing, new orders, these kinds of things increasing, building permits increasing a lot more than what they've done. New orders, I mean, those would need to be positive to really say that, yeah, we have a robust and resilient economy. Because really looking at this right now, it is debt driven and it is speculative or in the market driven. So not, you know, not the strongest foundation.
We want employment.
Right.
Consumer price
Right,
index.
CPI.
Yeah.
If anyone has been paying attention, the CPI has started to tick back up. And there have been we've been talking about the idea that inflation is going to be here and last for longer. The other sort of, I would actually say it's a little deceptive the way they kind of chart this to show, oh, this huge drop. It doesn't take into consideration necessities, right? Things like shelter and energy and food.
At the level that really, I mean,
at the level
like
that matters to
basically,
people,
yeah, I mean,
right?
you know, basically, you know, I think how much are people spending on rent now? I mean,
Yeah.
more than 50%, but they
Almost
don't.
doubled or
Yeah.
close to double over the past 15
Yeah.
years or so.
So they don't really weigh the components properly. I think when we talk to most people, they know they're having a hard
The
time.
lived experience is very different than
Yeah.
this chart.
Yeah.
But regulators, the Fed, they use this information to make a lot of their policy decisions off of. And so when they see it
Yeah,
start
they
to creep
manipulate.
back up, that sends warning
They do,
signals.
they manipulate the data, let's face it.
This sends them a signal, hey, we have to be very careful because we don't want to get caught in a situation where this gets out of control and goes back up. The eerie thing about this chart too, history doesn't repeat, but it often rhymes. If you were to overlay this to a similar situation in the 1970s, it mirrors it almost perfectly, where there was this first big run up in inflation and then it came down significantly, sort of leveled off for a bit, and then there was an even larger
That's
spike
what I'm
up.
worried about.
And so
that's what I'm worried about, and it has a lot to do with like the unrest around the globe, like just all this tension.
Because when you add in all the uncertainty, all the tension, sort of a shifting geopolitical picture, it just adds even more uncertainty. It adds more pressures that could really push inflation higher. So it starts to make the case that, you know, there's a non-zero chance that this could really reignite here.
Yes, I agree with that.
And then I think it's important to point out that it's come down to this 3%. The target, and that everyone has always been talking about for decades, was 2%. That's the normal rate of inflation.
I don't think the lived experience is 3%. We usually put in something called shadow statistics, which is it's a private group that actually measures inflation and all kinds of data.
They basically use the same calculations that were used in the 80s.
Yeah.
So there was a government calculation that they used to calculate what inflation was. But since then, they've just kept manipulating it and
manipulate the basket
to make it arguably look more appealing.
Yep.
But that's where we are.
Where we know.
So this was a bit of good news. This just came out this week or last week that it looks at manufacturing in the United States. Anything below 50 signals contraction. And it's been below 50 for years now.
Yeah, it's been below 50 since COVID.
Yeah.
And so it's you can see this chart. See, you can see what Paul has here, 23, 24, it's been below, and now it just ticked up this year, thank God, because we need manufacturing to come back. This is huge.
These are high quality, higher paying jobs. And so seeing this is a good piece of data. It's encouraging.
You know, kids with parents with kids, I mean, honestly, we need welders, we need people, we need electricians and plumbers. I mean, I have to say, I have said this years ago, I feel like, first of all, we have a lot of multi-millionaire clients who are plumbers and electricians because they're really smart.
Yeah.
But I just want to also say that this is a very honorable and our work looks like a great place for people coming out of school if they are not inclined towards more of a college, 4-year college degree to consider this because I think their future looks amazing and bright. So yeah.
Here's the services number. This one I put less faith in.
The purchasing manager index.
Yeah, the services. I mean, it's sort of been generally positive, regardless of what's been happening anywhere. And maybe if we're looking at services as sort of lower education requirement service jobs, lower paying service jobs, those actually have done well. But again, that's not the foundation of a strong economy or society.
I mean, the services are there when you have a strong foundation. Okay, let's see what else do we have.
Okay, all right. So
consumer health.
Consumer. Unemployment.
Yeah, which I think is going to tick up.
Yeah, I thought this was interesting because if you this goes back to the 1950s and you can see unemployment sort of moves in a pattern. Right, where it's relatively flat for a while, and then all of a sudden it slowly turns, and then it shoots up, and then it comes back down. And it's done this cyclically for 70 years or so. And so to see this sort of start to tick back up, it just raises a little warning flag to say, hey, this might be something to pay attention to here.
Well, we know they're playing
and we know,
Washington,
right?
D.C. I mean, let's put that out on the table. That's happening, so we know that's going to tick up. With that number after the 8 months.
That will add some to it.
They have 8 months of severance, so they won't be counted at this point.
Yeah. Right. And so to see this tick up before that is a little concerning.
Next.
Consumer credit.
Yeah.
So this is just an interesting chart from Bloomberg that looks at record month for household borrowing. So how much households are how much are they using debt? And the number of credit outstanding on credit card balances, non-revolving loans, has hit a high that at least since 2000, it's never been higher. So the question is, are more people making ends meet using debt, tapping credit cards, tapping their reserves?
Yes. The answer to that is yes.
Not a great picture.
Yeah, no. So I'll answer that. I mean, clearly, I'm just going to say, clearly we see a lot more people putting money on their credit card to get by and like that.
No, concerning. So this was interesting. We've talked to a couple realtors who have told us, especially, and real estate is very local driven, but that at least in our neck of the woods, there's still no inventory. And while some people have pulled their houses off the market, there's a very, very constrained supply, but there are still buyers.
There's buyers. So there's no lack of buyers. Like we said, this is part of our theme. This has been around for a while. We don't think that the price of the houses are going to come down significantly. We said that even when the Fed was raising interest rates, which would normally begin to reverse the direction, there's a number of reasons. We have private institutions buying these properties. Not good. And that's driving up the price of houses. And then also, like, because interest rates are so high relative to somebody with a 3% mortgage, a lot of people don't want to sell at this point.
Like they could sell and get a huge premium on their house, but if they're going to buy something new, they're probably losing money. Or the potential exists. So
right, let's roll. Yep.
All right,
corporate health.
Corporate health. Companies.
We've said oligopolies are being created. So big is getting bigger. No question about it. And there's a ton of oligarchs too. But oligopolies are being created. And there are certain companies and certain sectors that look very healthy, and then others that don't. So let's roll.
So just looking really quick at earnings per share estimates this year are tracking above the median. That's generally a good sign for companies. Earnings growth, again, this is big, get bigger. You look at the gap between the top 7 companies and the other 493, and it just shows how dominant they are.
So, can you get me back to that? Thank you. So just, again, this is first quarter of this year.
Yeah, these are the
Yeah.
projected
Earnings
earnings growth
growth.
year over year.
Yeah.
for
So this
2020.
is Mag 7. This is for the rest of the market. Okay. This is the second quarter. This is the third. You can see like they're expecting earnings to really be good out of the Mag 7. I worry about that a little bit because I think there's a little bit of a bubble there, like you can see NVIDIA definitely they're bubble propped. Microsoft hasn't really done much. We still own it. We still own it because we believe in it long term, but yeah. Anyway, let's keep going.
This chart really caught my attention because it looks at R&D or research and development. And you can really see since the 1960s and before, government really led the way in this. But sometime after 2000, the great financial crisis, really sometime in 2010. Well, actually, this is just looking at the Mag 7's R&D. I was thinking this was corporate
No.
R&D in general.
No.
This is so since 2010, those 7 companies are spending more on research and development than the entire U.S. government was,
That's amazing.
or at least caught right up
I
to
mean,
them.
that is like, that's just huge when you think about
Yeah.
it. That's
Absolutely wild. It really speaks to the idea of oligopolies and power concentrating because now you have these
not good.
essentially these
I don't like
digital these companies that have an insane amount of data and an insane amount of power too.
All right, global credit cycle. Yep.
I might have needed to change that.
Yeah.
Yeah.
41% of revenue. Yeah.
This just shows,
Yeah, that's-
those the largest companies, right? More and more of their revenue, really since 2019, has started to come abroad. So
Yeah.
to see if that trend continues. Here's the
Yeah, this
public
is really
companies.
important. Okay, so I'm going to share honestly. Years ago, when I started the company before we merged, we opened in 2009. I said to Paul, the stock markets are going to be extinct in our lifetime. Okay, and I'm still convinced of that. I don't think anybody else is going to say that, but I'm convinced of it. And what this shows you is the amount of companies at the beginning of this. You see there's 8,000 companies.
1996, right? 8,000 publicly traded.
8,000 publicly traded listed companies. Now we're down to 4,000. Now, why do I say it's going to be extinct? I'm just saying because more and more companies are private and staying in the hands of private and private equity. And I just think eventually within time, this will be, because I find it really interesting. If you really think about it, there's 500 stocks in the S&P 500 and really 7 of them accounted for what 90% of the performance last year.
Yeah, it was huge.
Yeah.
Yeah.
Like maybe 10 accounted for 90% of the performance last year. That speaks to this. So anyway, that's just my wild card. I'm throwing that out there, and you know what? Just know that we know. And so we strategically plan the portfolios accordingly.
There was another chart I wanted to add that complemented this that showed market cap of these companies, and it was the exact opposite. So you could see that as the listed companies go down, the market cap of the remaining companies continues up, which again speaks to our theme of consolidation, oligopolies being formed. The trends are there, but it also shows that this has been driven by policy over the past several decades. This isn't new.
This isn't new. Yeah, this is like I just have to keep saying this because we see so many people angry on one side or the other and this or that. We don't ascribe to any of that because honestly, we've seen in our data, it's been in the works for a very long time. And it doesn't matter. It's been in the works a long time. Instead of going like this, go like that to,
pulling the strings.
Who's pulling the strings, So anyway, that's my advice.
Wild.
Yeah.
So here's some potpourri, right? I don't know what to call it, so I call it global stuff. This I thought was fascinating.
What's this one called?
So in 2000, the US, in the year 2000, the US was the main trading partner for most countries in the world. So any blue country there is a main trading partner, or the US is that country's main trading partner. 20 years later, the red is now their main trading partner is China. So just, I mean, the change here of US dominant in 2000,
Things are changing.
2020, look at how much that has changed.
Yeah,
Absolutely
again,
wild.
another one of our themes is that eventually the US won't be the dominant player, this is clear. And that the dollar will not be, will not be the reserve currency in the end. I am convinced of that.
Yeah, this is
And when
definitely
you see
leading,
this,
definitely leading to a more disjointed, multipolar type world where it's not a unipolar US, whatever the US says goes. There
Exactly.
really are sort of factions being formed and entire supply chains being shifted all over the place, and we're sort of in the midst of all that right now.
yeah,
But the trend is pretty clear.
sure is. I mean, could you get any clearer? Okay.
I wonder what it is actually now, because this was from 2000, so I'd be interested.
Oh,
to see
yeah,
what it is.
substantially more because
bet
of the
it's-
sanctions we put on Russia.
Yep. Yeah, that would.
So they really became independent of us. Yeah. All right, let's see.
And then I thought this was interesting too, just to get a number to it. Chinese exports to the US are only 15% of their total exports. So at one point, the US was, I think, the largest
We were.
importer of Chinese goods
Mhm.
by a wide margin,
So we're becoming insignificant.
but now we matter less and less and less to them. So-
Like, get real, people. We are becoming, and again, see, like these charts, all this stuff speaks to this all being in motion for a very long time.
Right. I mean, just over the past 25 years, it went from 22 down to 15 or
Yeah.
so. So
Yeah.
these are big moves.
And do we have anything else?
Just some quick market charts. This is just the ratio, just to give everybody an idea of some of the high top level thinking that we're doing. This is looking at the S&P 500 compared to a small cap index. So if this line goes up, it says that large companies, the S&P 500 is outperforming
The
small
small
cap, the
companies.
small companies.
Here the small outperformed,
Yep, from the early 2000s all the way until
right about,
2015,
Yeah.
2014 or so. Small cap just outperformed, but really since then, large cap has been dominating, which,
and this is a big chart, because I think it's still going.
oh yeah, the
This
trend
is
doesn't
big.
look like it's stopping.
The trend is your friend.
Mhm.
That's how we work.
And you can see this really play out across different things too. So this is again, S&P 500 compared to essentially Europe, but it's more the EFA, so
Could be all
developed, right, developed
Zealand.
countries, not
Yeah.
not emerging markets, but developed countries.
Yeah.
So where would your money go if you were to invest back in 2009 in the US or foreign developed countries? If
Yeah.
you went foreign developed, you just lost.
This shows that the
US
US
just
way
dominated,
outperformed.
right.
Definitely.
Yeah.
And then
Same
here's-
in emerging.
Yeah, we dominated. Now, we think this is the boats don't turn quickly.
Right.
They go really slow. We are really liking the emerge. We are seeing
Mhm.
some really good signs coming out of the emerging economies. I'm still gonna say it here, they are gonna be winners in the end.
Yeah.
I think.
And I would also caveat this chart is that it's looking at a specific index of emerging market countries, which is way overweighted to China.
Yeah.
So it's not a true representation of all emerging markets, but more so the US.
Ooh. Here's the next one. Oh, gold.
Yeah, and so this chart looks at
We
gold, the
like
price
gold.
of gold
We have gold for you.
Yeah.
We've had it for a long time.
compared to TLT, which is a proxy for the 20-year treasury. So if you were to have bought the 20-year treasury and just held on to it, you would have lost your shirt compared to just owning gold.
Again, take a look at that, the spike in this chart, okay, which shows you this spike's been happening for a long time.
Yeah.
That someone knows there's high risk, someone knows there's high inflation, someone knows, and they were getting in beforehand.
Mhm.
Okay, because this charts don't lie. It's a good leading indicator, and that is saying that there's trouble ahead, but it's been saying that since like 2021.
Pretty much since COVID.
Mhm.
Which is interesting.
2021.
I mean, the thing to
So-
remember, right, is gold is a traditional safe haven asset.
Mhm.
And so you'd see the price of gold rise when global uncertainty increases.
And that certainly is the
I
case.
think this speaks doubly to that because it's also
Yeah.
looking at US treasuries too. So if gold is not only price is going up, but it's going up significantly, especially compared to US treasuries, which are supposedly the safest asset in the world. It just raises some, whoa, but that's something to pay attention to.
Yeah.
Not that we think the treasury is going to default anytime soon. I mean, I guess the potential's always there and we never know what could happen.
Wild card.
Wild card.
I do think something will not be so great. But
And
let's see.
that's all we've got today.
Let's see, let's go to the participants. So if you have any questions, we're still here. We didn't lose anybody yet. You want to raise your hand and ask a question?
Feel free to throw it in the chat. Either
Or
way,
throw it in
we
the
did
chat.
have a few questions that came in
Oh,
prior.
let's answer those
The
right now.
first one was, let me see if I can pull it up. Yeah, it's now the time to buy gold.
We like gold.
We like gold. Yeah.
We like gold. Yeah.
Let's see.
We own gold for you. Okay.
How
I know who asked that question. I see it here.
how will Trump's action, or how will the new administration's actions and orders affect markets and other investments? So that's something that it's kind of we need to wait and see what the actual policies are. There's a lot of talk right now and opinion on this and that, and there's a lot of noise out there, but there isn't a lot of clear directive of this is the policy and this is how it's going to be enacted, which we can then build. I keep saying, from that we can really determine second order and third order effects.
Exactly.
But we just still don't really have that certainty yet, and would much rather wait until we give it a few more months, several more months even before we
I mean,
understand that.
okay. I agree.
But uncertainty is high. I mean, that's-
I agree, and again, all of these balls have been in motion before he even stepped foot in the White House. All of these balls have been in motion, bipartisan, no matter who has been in there. Republican, Democrat, does not matter, okay? I just really want to say that all of these imbalances have been there. And they're getting more obvious, I would say, to people. So we are going to pay the price for this. It's a question of being a drunken sailor and spending way too much money that we don't have. And that's been going on for decades, literally. Question is it getting closer to when that's going to pop, right? My intuition, just my feeling, is that something will transpire. This is going to be a challenging year, 2025. It's already shaping up to be a challenging year. So, yeah. So I think
Yep. And then the next piece, next question that we had was let's see, where do we go from here?
yeah.
It's a great question.
That's a really good question. So we continue to be, we have what we call, hedges against in the portfolio, which is gold and crypto.
Certain non-dollar things.
Certain non-dollar
Certain
denominated.
foreign bonds.
Certain foreign bonds, yep. Also, enough in cash, we think, and in the right sectors, Where we head from here, who knows? What I feel is Paul and I just have to keep working with what's showing up as it shows up, hopefully before it shows up. I mean, one of the things we did do is get out of healthcare. Last year, we think it was the right move. Too much uncertainty happening there. We think a lot of hospitals are definitely in trouble.
Positions.
Yeah, we moved ahead of this into some of the bigger companies. We moved ahead of this into gold. So what next? What next? I think what next from an investment perspective, hard to tell. I just think what next from our personal perspectives is make sure that we hold. Let's try not to have all these high tense conversations between us and recognize that we're in this boat together. So we really need each other desperately to make it together, you know.
Historically, there's always been opportunity
Mhm.
somewhere to make money, and we believe while our overall portfolio is definitely leaning more conservatively positioned, which we've been talking about and really planning for the past 2-3 years.
Right,
That there are, even within that, there are sectors that we like.
yeah,
Certain
I mean,
companies,
faster
certain
than the
areas, right, and
partnerships.
certain energy
Yeah.
plays, but it's much, I would argue it's much more nuanced and selective
Yeah,
than it's
totally.
really ever been.
Yeah, totally.
And at least from my experience, and you can go back a little further.
I can.
Just that normally you'd want to see that rising tide lift all boats.
Yeah.
And we're just not seeing that still.
Let's see, do we have anybody who, nobody raised their hand? Okay. Cool.
Well, thank you so
Thank
much.
you.
And if you do have any questions or there's anything you'd like us to touch on in the future, shoot us an email, give us a call. Happy to talk about this stuff.
Thank you,
We love it,
everyone.
so.
Yeah, thanks. Have a great day, everyone.